Today's lesson, we are going to be looking at another very important topic. It is called correction of accounting errors. Correction of accounting errors. You see, the name is very, very unique to accounting. You know, some textbooks will call it correction of errors, but that will be very, very ambiguous because, you know, you can't correct all the errors in this life. So we have to streamline the topic to our area of specialization, which is accounting. So the error that we are going to look at in this lesson is basically accounting errors. So that is the topic we are going to look at. Now, but before then, let us look at our guide, what we guide our journey in today's lesson. I call it lesson objective. What are we looking at? You know, those focus we are going to have, or the focus we are going to have within the lesson. Number one, we are going to define what accounting errors are. What do we call accounting errors? And then we're going to identify the types of accounting errors we have. How many types of accounting error do we have? And then we're going to describe errors that will not affect the total of the trial balance. And then we are going to post corrected errors into the journals. Now, having said that, let us look at what we serve as our success criteria. What are we looking at? If we are able to achieve this, can we really say we have achieved our objectives? Yes. What are those things? Number one, if at the end of the lesson we are able to define accounting errors, we are able to identify the types of accounting errors, and we are able to describe errors that will not affect the total of the trial balance, and then we are able to post corrected errors into the journal, then we can beat our chest and say we have achieved our objective. Now let's look at the definition of accounting errors. What are errors? Or what are accounting errors? Accounting errors are simply mistakes made in the preparations of accounts. You see, if you are a layman and you are not in accounting, you may not believe, or you may not understand, or you will be surprised to hear that accountants make mistakes. They make mistakes during preparation of accounts. They make a whole lot of mistakes. So we have devised a means to correct these errors or this mistake in a professional way. In accounting, there's no mutilation. We don't cancel. So what we do is that when an error is made in the posting process, we have a system that can be used to correct such an error. And that's what we are going to look at today. So we have said that accounting errors are simply what? Mistake in the preparation of account. Now, what are the types of error? In what ways can an accountant make mistake? Number one, accountant can make a mistake that will affect the total of the trial, that will not affect the total of the trial balance. An accountant can also make a mistake that will affect the total of the trial balance. You can see now that the trial balance is now the benchmark. It's what will determine if a mistake is made or not. Now, if you've not gone through trial balance, I encourage you to go and look at trial balance, because trial balance will give you a clear picture of how this mistake can be made. But for the purpose of today's lesson, we are just going to look at the error. We're not going to look at trial balance. But let me just give you a glimpse of what trial balance looks like. A trial balance is simply a list of balances extracted from the ledger to test the arithmetical accuracy of the ledger. Is there error or errors, or are there errors in the ledger account? Yes. How did you find out? My trial balance was able to point it out. How were you able to see it on the trial balance? If at the end of the preparation of your trial balance, the debit side is not equal to the credit side, then it will be very obvious that error has been made. But let me surprise you. Do you know that there are times when the debit side of the trial balance will also be equal to the credit side, yet there are errors that you cannot see with your naked eye. Those errors are errors we call abstract errors, are errors that do not affect the total of the trial balance. And that's where we are going to major our discussion today. We are going to emphasize on this. I want to appreciate this class or classes of errors. How can somebody make an error and then the trial balance will still be balanced? Now, errors that do not affect the total of the trial balance. We said the trial balance is a test of arithmetical accuracy of the ledger. Hence, the debit side must be equal to the credit side. In some situations, the trial balance may be balanced, but there are some errors which may not be disclosed. These categories of errors include: number one, errors of omission of transaction. When transactions are completely omitted, then the error will not be seen or cannot reflect on the trial balance. What am I talking about? If I say John, if I say paid salary by check, paid salary, 50,000 cash, 50,000 cash. You see, there are two accounts that are involved here. In every single transaction, two accounts are involved. We have the salary and we have what? The cash. So in your ledger, you are going to have an account open in the name of what? Salary. And you are going to have an account that is open in the name of what? Cash. Why cash is going to be your asset? Cash is always an asset in the trial balance. Then salary is going to be an what? It's going to be an expense. So now, when you prepare this, now you pay salary, you're going to have salary account, and then your salary account here, this is your credit side, this is your debit side. This is how it's going to look like in the ledger account. And then what did we do? We paid because salary is the one that is receiving this payment. We are going to debit salary. You write cash here, and then this is your 50,000. And then you have the next account is what? Cash account. And then you have your debit side, you have your credit side, your naira signed. So because you have debited this, you are going to credit this. You write salary here, and then you have 50,000. So if in the process of extracting these transactions from the ledger, if you omit this transaction, omit the cash and omit the salary at the same time, you have committed an error called error of omission. And such an error will not reflect on the trial balance. But if you omit one side, if you omit this side and then you are able to take on a salary, it will show. So error of omission comes in two forms. It comes as what we call one-sided omission and complete omission. When it is complete omission, the two accounts are completely omitted. But when it is one-sided omission, one part of the account is what? Omitted. So when there is a complete omission, it will not reflect on the trial balance. The next one is what we call compensating errors. Compensating error here is derived from what we call compensation. You did something for somebody and you are expecting reward. You say, please pay me. I deserve to be compensated. So there are errors that compensate themselves. When errors of the same nature and caliber are made, the same nature and strength are made, they can cancel out. If a transaction of 50,000 naira is made, and then the error you are making has the same amount, that 50,000 will cancel 50,000 and it will go. So the error of 50,000 will cancel another error of 50,000 and both of them will just go, especially when it has to do with the opposite side of the account. When the error is made on the debit side and the other error is made on the credit side, it will just compensate themselves and that error will just go silent. Nobody will know about it. I'm scared. I have to mention it that this is an area where accountants sometimes they falsify figures. They can remove 100,000 from the debit side, remove 100,000 from the credit side, and the account will still balance. You know, that 100 will cancel the other 100 and the account will still balance. That is the work of fraudulent accountant. So in this case, the debit side will cancel the credit side and the error will cancel out. Then what we call errors of original entry. Error of original entry is when the figure is compromised. What do I mean by compromise on the figure? A figure that is expected to be, for instance, that is expected to be written, for instance, you have 310 for a transaction and then you mistakenly write 301. You see, this is what people usually do. Sometimes they can make this kind of mistake. 310 is mistakenly taken as 301. This kind of error is called original. Why did we call it original? We call it original because this is the original figure. This is the original figure, and this is the error. This figure is a figure that is gotten. That is taken because of error. So this one now will affect the transaction. But what usually make it insignificant or what make it hidden is when this error is made, it's going to affect the two transactions. If I say that salary paid for 310 in error has been posted as 301, the cash book will carry 301 and then the salary will also carry 301 and it will just cancel itself out. Then the next one is what we call errors of commission. This error of commission is very common when an accountant is working in an environment that he or she is not familiar with the names. You see something like Baritule and Bariture. You see Baritule, and then you see Bariture. Or you see something like you see Ifoma and Ihoma. You see, if an Ogoni man is working in an Igbo land and then Ifoma decide to credit her account with 10,000, maybe Baritule, the person working, the accountant who is an Ogoni man working in an Igbo land, may not be careful to know that there is an Ifoma and there is an Ihoma. Maybe both of them might just be the same. They might just be customers of the bank. So if the transaction of Ifoma is posted to the account of Ihoma, that error is what we call error of commission. You have used what belongs to customer A for customer B because of similarities between the names. The same thing with Baritule. Baritule means God lives in Gokana. And then in the same Ogoni land, Bariture is for Kana. So if you are not in Ogoni and then an accountant that is coming from a different tribe is coming to transact business or trying to prepare account in Ogoni, and the person mistakenly post transaction that is meant for Bariture because of similarities between the names, it is called error of commission. So what will happen is that it will not show. It is only the name that is there. The real transaction will go where it's meant to go. And then the next one is what we call error of principle. This one happens when the wrong class or classes of account is involved. Account is basically divided into two: personal account and impersonal account. Personal account are account open in the name of individuals, while impersonal account are account open for expenses and income. So when an account that is meant for an individual is posted to an account that is meant for an expense, you have committed an error of principle. Like for instance, if I say expenses, if I say cash 10,000 paid for motor expense has been debited to motor vehicle account. You know, cash 10K paid for motor expense has been debited to motor vehicle account. Motor vehicle account is a real account. This is a real account. While motor expenses is what? Is a nominal account. This is nominal account. This is an expense, while this is an asset. So if you now post this 10,000 that is meant for expense into real account, into asset account, you have committed the error of principle. You know, this error is common with others who didn't do accounting. Some persons will read business admin and some other discipline, and they want to come and practice account. If you don't understand this fundamental principle, you can mispost transaction. Transaction that is meant for a particular class of account can be misposted into another class or classes of account. The second to the last is what we call complete reversal of entries. This one is very simple. When we talk about complete reversal, is what is meant to be debited is credited, and what is meant to be credited is debited. That's just it. It's complete reversal. What you are supposed to debit, you credit, and what you are supposed to credit, you debit. Like for instance, if I say paid, or if I say, let me assume I say bought goods 10,000 naira cash. The two accounts involved here, they are what? Purchase and the word cash. So you have purchase. This purchase is supposed to be what? Debited, and cash is supposed to be credited. Why? Because when you buy, purchase is receiving and then cash is given. So if you now debit cash, if you debit cash and then credit purchase, you have committed the error of what we call complete reversal of entries, because what is meant to be credited is debited, and what is meant to be debited is what? Credited. Then the last but not the least is what we call transposition error. This error is always very silent most times, because sometimes it looks like error of original entries. It is an error where if one side of the account is maybe is debited and the other side is omitted, like what I said about one-sided omission. This is a typical example. It's transposition. It talks about the position of the transaction. So far, we have looked briefly into the errors that do not affect the total of the trial balance. I have said that these errors are errors that do not affect, because these errors will cancel themselves out. Now, let's look at how to post the corrected errors into the journals. First of all, what is a journal? A journal is a book that is prepared to record transactions in their order of occurrence, or we call it chronological order. They are written in their order of what? Occurrence. All the transactions in the business cannot happen the same day, because they must happen in sequence or in series. So what is going to happen is that a journal will tell you when transaction took place. It will tell you the nature of the transaction and the narration. That is a topic on its own. Students are encouraged to go and look at what a journal is. But for the sake of this, a journal looks like this, because that is what we are going to use to correct our errors. So a journal, once the error is detected and once you have made the correction, you have to bring it to the journal. So the journal will look like this. A journal, it does not have much write-up. Just write a journal like this, and then it has 3 columns. We have the column for particulars. We have the column for debit, and we have the column for what? credit. Let's assume we are using Nigerian currency. Some textbook will put date here. We just add date, but I don't think it's necessary because it's an extract. You are correcting error. There's no need for the date. And then there is another part of the of this journal that is very important. It is called the narration. So when you do rule your line like this to demarcate one transaction from the other, narration usually come here. This is where your narration will be. Like for instance, let me commit an error here, or let me make a mistake here and then correct it on this. Okay. Okay, let's take salary paid, or let's say 10,000 expenses, cash paid 10,000 naira cash. Motor expenses 5,000 naira cash paid has been debited to motor vehicle account in error. All right. Motor expense account, motor expense 5,000 cash paid has been what? Debited to motor vehicle account in error. Look at this. This is, first of all, for you to appreciate this error, you must ask yourself, what kind of error is this? This is error of what we call error of what? Principle. Because motor expense, I've explained that motor expense is a nominal account. It's an expense. While motor vehicle is a real account, is an asset. So when motor expense is paid, motor expense is supposed to be what? Debited and then cash credited. That will have been the straightforward posting. Motor expenses is supposed to be debited and cash was credited. But they said that this transaction was now debited in motor vehicle. That is what is bringing motor vehicle into the scene. So what will you do? You are now going to bring these two together. It's going to be, the transaction is going to be between motor expenses and then motor what? Vehicle. So what will you do? You are going to correct the error. I said from the beginning that we don't mutilate, we don't cancel. There's no mutilation. You know, a layman will just come to the book and just rule it like this. You just do something like this. We don't do anything like this. You can professionally prepare a journal to correct the error one after the other. So when you come here like this, you have written your motor expenses, and then your motor expense account, and then your motor vehicle. You have already debited this amount into motor vehicle. So what you are going to do to remove this amount from motor vehicle, you are going to credit it with 5,000. You are going to credit. This credit means you have removed this 5,000 naira from this. Let me show you what I'm talking about. Let's assume this is your motor vehicle, motor V account. And then in error, this money was what? Debited. You write cash and then you write 5,000. This is what the accountant did. The accountant made the mistake of debiting motor vehicle with this. This is the error that was made. So what you are going to do right now is that since the cash has been credited, somebody will ask, why is it that in this correction, cash is not reflecting? No, cash is no longer reflecting here because the transaction has been completed in cash book. The error was made in what? Motor vehicle. Motor vehicle account was actually debited in error. We have credited cash, so cash book is correct. So cash will have nothing to do with this transaction again. What is now needed here is to reconcile the error between the motor vehicle and the motor expenses account. So you just simply come and you are going to now credit this with what? Motor expenses. So you come here and then you write motor expense, and then you do what? You write that figure, 5,000. Okay, you write your 5,000 here. You see what is going to happen here? 5,000. Why did you write motor expenses here? In your motor expenses account, okay, let me remove this. In your motor expenses account, in your motor expenses account, you have, this is debit, is credit, you have this. You are doing the correction now. You now have your motor vehicle what? 5,000. This 5,000 is this. You can see now motor vehicle, motor expenses. So by the end of the day, this 5,000 will cancel this 5,000. This account will now remain null and what? Void. And then you have effected that. So at this point now, the reason why this money is here like this is because anybody that look is a correction. Anybody that look at it, okay, fine. The reason why this money is here is because you took this money from motor vehicle account. That is why it is here like this. So what is going to happen is that since you have credited this, you are now going to debit this. You debit with 5,000. So the narration here is simply what you have done. What have you done? You can now say error of principle now corrected. Error of principle now corrected. Simple. You have completed that transaction. So at that point, we can now say error of principle now corrected. So that's how to prepare. So the job, it will now continue. This thing will now continue. You use this line. Use this line to demarcate this transaction. Now you go down again. You check the book. You do another correction here. You use this line to demarcate until you are done with all the errors that you are expected to correct. So that's how to correct an error, or that's how to correct error with the journal. So anytime you are asked to journalize, they'll ask you to journalize, or they will say post the corrected errors into the journal. This is what you are expected to do. All right. So far, we have looked at the correction of error as a topic, and we just want to go to our exam guide now to really find out if we can get some questions that is related to what we have done so far, so we'll be able to explain further what we are talking about. When you click on the exam guide, you see what is shown on the screen. You see account is already clicked because that's our subject of interest. And then when it comes to year, you can choose any year of your choice. Students will want to find out from a particular year the question that is set based on the particular topic. You can click on it. If you click on it, you see different years. It's written there. You can choose any year of your choice. But for the sake of today's lesson, I decided to choose at random because I just want to comb all the questions together under this particular topic. And then the topic is selected already. It is correction of accounting errors. Once you have done all of that, you can now click on your get started. Then some related questions will come up. Okay, look at the first one. Cash paid to Jack, 2,500, was entered on the credit side of his account and debited to cash book. This is an error of what? Very clear error. I have said it from the beginning that in accounting, we give to decrease, and we receive to increase. So we always debit who receive, and we will credit who give. So ask yourself, in this question now, they say paid to what? This Jack, this guy, we have paid this money to, is receiving this money. So by right, Jack is supposed to be what? Debited. And then cash is supposed to be what? Credited. But what did the accountant do? The accountant mistakenly what? He credited the cash book, and then he credited Jack and debited cash book. That is what we call a complete reversal of what? Entry. So at this point, Jack is meant to be debited, and then cash book is meant to be credited. So what I want to do now, if I'm asked to correct this error with this, to post that correction here, look at what I will do. Look at what I'm going to do now. We are not asked to generalize that, but I want to show you. Now, this is if you were asked to represent the correction on the journals, you just come here, you write our brother here, Jack, and then you write cash. You write cash. So what are you expected to do? Because Jack is receiving and cash is giving, you are expected to debit. You are expected to debit Jack. So you write 2,500 and then you credit cash 2,500. Say bin, or you can just put error of what? Complete reversal. Now corrected. Now corrected. You have completed that error. Error of complete reversal. Now what? Corrected. So the answer here is complete reversal, which is B. And then the next one, they said, which of the following errors are errors of commission? Which of the following errors are errors of what? Commission. What did we say about error of commission? We said when there is a similarity between names, the accountant may not really know who to post the accountant may mistakenly post the transactions to the wrong person. Let's look at I. A check paid to Adam debited to Adam's account. Credit sales to Eva credited to sales account but debited to Eve's account. Furniture repairs debited to furniture account, and then credit purchase from Manu credited to Manu's account. See, very simple. Anyone that has to do with similarity. The first one is what? Check paid to Adam debited to what? Adam's account. That's number one. And then credit sales to Eva credited to sales account. Okay, but debited to Eve's account, number two. Furniture repairs debited to furniture account, that's not. Then credit purchase from Mamu credited to what? So it's going to be 1, 2, and 4. So the answer is supposed to be number 1, number 2, and number 4. Credit purchase from Manu credited to Manu's account. This credit that is we are supposed to pay to Manu, we have this account has been credited to Manu's account. Is it Manu or okay? It's going to be 1 and 2. The last one is the same thing. M-A-N-U and then M-A. So there is no difference between the name. It's the same person. It's actually the same person. So the answer is going to be 1 and 2. Number 1, check paid to Adam debited to Adam's account, and credit sales to Eva credited to what? To Eve's what? Account. This number 4, this name and this name, they are the same. So it's 1 and 2, which is A. And then they said an amount of 2,000 received from a customer Kofi has been credited to another customer, Kofi goes account. This is an error of what? Commission. All right. They said a total of 9,160 was entered in the sales account as this is error of original entry. To correct this error, you are going to look at, first of all, you are going to subtract the original figure from the wrong figure. They say a total of what? 9,060. You have 9,160 was entered in the sales account as 969610. This is the original figure. This is what entered the account. So if you subtract this 9610 9160, if you sub, this is 0, 11, this is 5, this is 5, this is 4. So the difference is what? 450. 450 is the difference. Now, this is the original figure, and this is what is obtainable. That means there is need to add 450 to this. There is need to add 450 to this. This is the original figure. Okay, there is need to subtract 450 from the account because this is the original and this is what was posted to the account. So 450 is going to be deducted from all the accounts that are involved. Any account that is involved in this transaction, you remove 450 from it so that you can get this. So let's look at the account that are involved. The account that are involved, they are sales account and cash account. Okay, sales account and cash account. Now, but it is a credit transaction. A total of this entered in the sales account as this. To correct this error, debit. Already we have entered the sales, so we are going to debit. We are going to debit sales day book with 450, and then we are going to credit no, and then we are going to credit suspense account. So sales account and credit and suspense account, sales account and suspense account. We are going to debit sales account and we are adding. We are going to credit sales account and we are going to debit suspense account. So let's look at, we are going to credit sales account and we are going to debit suspense account. All right. So we will debit suspense and we are going to credit because we are adding this value. We are going to add this value to say so. Credit entry in an income account is addition. So we're going to add this. So it's going to be credit sales account and debit suspense account. Which option is that? Sales day book? No, it cannot be A. You are going to debit suspense account and credit sales account with 450. So the answer is going to be B. That's the answer. You debit suspense account and credit sales account. And then sales of goods for this to Ade was not posted. Sales of goods for 600 to Ade was not what? Posted. This is an error of what? Omission. Let's take the very last question. They say repair rent of this has been recorded as this. This and the same thing. This is an error of original entry. I told you from the beginning that error that has to do with figure, changes in the figure, is for original entry. All right, so far that is all we can take on in our exam guide. But before we end the lesson, there is need to take a recap of what we have discussed so far. First of all, we have said that accounting errors are simply mistakes made during the preparation of account. Accountant can make mistake, and so because we don't mutilate, we don't cancel, we have a professional way of correcting our errors. So when mistakes are made, then there is need to also correct them. So the correction that is made is what we have been doing so far. So we said accounting errors are mistakes made during the preparation of account. And we said we have two broad classes or classification of errors. We say number one, error that do not affect the total of the trial balance, and errors that affect the total of the trial balance. We said the errors that affect the total of the trial balance, they are number one, error of omission, error of what we call compensating error, or error of original entry. We have the one we call error of principle, error of commission, error of complete reversal, and then transposition error. These 7 classes of error, they are errors that even if the trial balance is balanced, the debit side is equal to the credit side, you still see that these errors are made. They are so abstract, so insignificant in operation that you may not see them, but in principle they are very, very fundamental. It will mar the credibility of the account. And we have said that when these errors are corrected, there is an account, or there is a statement that is used to record them. They are called what? The statement is called a journal. Journal has a part that is for particulars, a column that is for debit, and a column that is for credit, and then it has a part that is called the narration. The narration is a place where you communicate to management, or you communicate to interested users what you have done so far. When you have corrected the error, you post it to the journals, you have to put the narration. So far, that is how much we can take under correction of error.